And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The tax wars have come to ETFs. Senate Finance Committee Chairman Ron Wyden has proposed a new tax on ETFs to help pay for the $3.5 trillion budget plan. The measure would stop investors from avoiding capital gains on so-called in-kind transactions, which allows traders to swap the underlying assets for another without producing capital gains. This is one of the big advantages of ETFs, folks, and it's on the chopping block. The ETF industry fighting back. Let's talk with Eric Pan, CEO of the Investment Company Institute, which represents mutual funds and ETFs. Ed Rosenberg is the Senior Vice President and Head of ETFs for American Century Funds. Tom Lydon is from ETF Trends. Eric, briefly, for those who are not familiar with all the advantages here of ETFs, what's an in-kind transaction? Why did the Democrats want to tax it? And why is this a big concern for the ETF industry?
Sure. So in-kind transactions are how ETFs manage their portfolios. It means when you sell a stock and you get a stock back, that's not considered a taxable event. Not 1969, IRS came up with a rule that said we're not taxing that. And since then, we've been relying on that tax rule. Senator Wyden would like to now make it a taxable event because he's trying to raise money. And the problem is he's punishing the investors. Because what happens is when you and I buy an ETF and we buy, we hold, and we don't sell for years, we pay taxes only upon sale. Senator Wyden would make us face a tax bill every year, and that's not fair. And that goes back to the point of it's bad policy because we're punishing long-term investors. We're making it more expensive for them. And this is dangerous. You know, today, a lot of people are interested in the markets. They're doing crypto, they're doing meme stocks, but we want people to invest for the long term because they got retirement goals or they've got education they need to pay for, their kids. They want to buy a house one day. And so Senator Wyden's actually, with his tax bill, is actually going to make it more expensive for these people to save for the long term. And that has real consequences.
You know, Tom, I can't help but think this is only one tax proposal that affects the financial businesses. There's plenty of other them out there. Biden also wants to boost the capital gains rate, now at a top rate of 20%. He's proposed boosting the top tax rate from 37 to 39.6%, and also having that same 39.6% capital gains rate apply to households making at least $1 million a year. How would that proposal affect ETFs as well? I can't help but think it's not good news.
Well, it's not good news. It's not good news for Wall Street. But if you think about those that are making $1 million or more a year, you know the government's coming after you. I think the key thing, though, is Biden has promised that if you make under $400,000 a year, don't worry, your taxes aren't going to go up. And what we talked about earlier is 92% of households, and there are 12 million households in the U.S. that own ETFs. They make less than $400,000 a year. Their median income is $125,000, Bob. So they are surely in that camp. We're supposed to be protected. And if this goes through, they won't be.
You know, Ed, none of us want to see higher taxes. I certainly don't. But how bad would this really be for the ETF business? I mean, you still have low expense ratios, right? That's not going to change. Would this change the way managers really run their funds? What's really at risk here?
I mean, it definitely is going to change the way managers run their funds. They're going to take more losses throughout the year or throughout time periods when there isn't rebalancing, which is really going to increase trading costs in the portfolio, which can dampen performance for clients. It's also going to increase selling of individual securities throughout the year and put more pressure on the sell side. Now, in smaller funds, obviously, it's not that bad. But as you go to the larger funds and they're trying to manage their tax lots to keep gains at a minimum or at zero, there could be a lot more selling that goes on, especially in markets that have dropped or, you know, sideways markets like today where you see parts of the market up and down. You could see more selling on those securities that are already down to build up losses in the portfolio. And really what it does is it changes how a portfolio manager in the ETF space is going to have to manage ETFs going forward if something like this went through.
You know, Tom, what is the rest of the ETF community doing about this? I mean, the big kahuna here is BlackRock. I mean, they manage, what, $9 trillion? They're a big ICI members. I can't help but think behind the scenes, they're pointing out what damage this would be to even average Americans, as you pointed out, not people making more than $1 million a year, but just people making $125,000 a year.
Yeah, well, a lot of people listen to people like Larry Fink for sure. I mean, what he's done for ESG has been really admirable, but we need him now. And I think Eric has a lot of the heads of these fund companies and ETF issuers together right there in Washington, D.C., probably doing what they need to do, which is rally around the tax safety of ETFs. I mean, we all know, Bob, we've been looking at mutual funds for a long period of time. And there's been periods when the market's underperformed, your mutual fund is underperformed, but because your fund manager had to sell low cost basis stock, you've been gifted this great distribution at the end of the year in the form of a taxable gain, when in fact the fund's gone down. ETFs haven't had to deal with that. And the great thing about it, when I look at Eric's organization, they see the benefits of ETFs, the industry's coming together. It would be a travesty if something like this went through.
Eric,
Bob,
do we know?
Bob, if I could say,
Go ahead. Go ahead, Eric.
Bob, so this is not about BlackRock, right? This is about retail investors, millions of Americans who own ETFs, and they own it through BlackRock, but they also own it through many, many different companies. And the fact is, why is this tax being added on them? Because they're the ones who ultimately are going to have to pay for it. Is this what we want? Is this really the objective? I get that they want to raise revenue, and raising revenue is an important piece. The taxes also affect behavior. It's about policy and whether or not we want Americans to invest. And that's why it's dangerous.
You know, but we know why this is happening, because $3.5 trillion is an awful lot of money, and you got to go very deep to get that. I mean, realistically, have you run numbers, Eric? How much money would this actually raise here? Your point is they're going after the wrong tax base, but you've got to go pretty deep down to raise the kind of money they're going to need, right?
Well, so I haven't done the calculation, and I believe the Congressional Budget Office is going to score this quite soon. But there are many ways of raising taxes, and the question is, who's paying these taxes? 12 million American families earning $125,000 a year, they're the ones paying these taxes, right? We look at young Americans, 33%, okay, of millennials have ETFs as part of their investment portfolio. We talk about Gen Zers, 29% of them own ETFs. So these are the youngest Americans who are just starting to save today. They're the ones who are going to be paying these taxes. So is it going to raise money? Sure, it'll raise money. Should we be raising money this way? No.
So you're the lobbyist, Eric. Handicap the chances this could pass.
Look, Senator Wyden is the chair of his committee. There's a possibility it could pass. I wouldn't be speaking to you today if I thought that this wasn't a proposal that had a chance. But I do have faith in our system that our policymakers want to do what's best for the country. And I'm hoping they're going to listen to the arguments, look at the merits, and realize this is a bad way to go.
Ed, for people who aren't aware of how the InKind transaction works, give us a simple example of how, like, an authorized participant creates and redeems shares in these ETFs, and how that does not create a taxable event. I want to make sure people just understand how this works, because this gets into the plumbing of ETFs, but it's always important for people to understand how important the InKind creation, InKind transactions are.
Yeah, Bob, it's pretty simple. So just use an example of somebody buying 100,000 shares. They put that trade in through their broker. That broker puts the order into the market. If the market doesn't have enough shares, it ends up on the desk of an authorized participant. That is the firm that is able to create or redeem an ETF shares. So they will gather the underlying securities that make up the unit of that ETF and exchange those for ETF shares. And when they do that, using an individual security, let's just say it's Apple, and it's $150 a share, the fund takes the cost basis the moment it comes in at $150 a share. And so that's when it comes in. And then ultimately, that once all those shares come in, the underlying securities, the shares are released and end up back in the client's account. If you do it the opposite way, when there's a redemption and the fund takes, what happens is the fund will then take all the underlying securities that make up that basket and move those out to the authorized participant. So in this case, I mentioned Apple was $150 a share. Let's say the fund paid $130 for that. The fund, it moves it out, and there's no gain on that sell. So somebody had sold enough shares, 100,000 shares, to cause a redemption, and that $20 gain in that security goes, no one pays that. So it goes from the fund to the authorized participant. The difference here, though, is this is not just an ETF rule. Mutual funds can do in-kind redemptions and in-kind money coming in, but also what you've done is, because the person who sold and caused that redemption isn't impacting all the other shareholders that own it, he or she is choosing when to take that capital gain by selling the ETF itself, as opposed to burdening the capital gain with all the underlying shareholders at a time they did not choose to sell. And so it's really creating a different. I'm sorry, go ahead.
I know this gets a little wonky, but I want people to understand the difference between that and what happens in a mutual fund, and how that can create a different situation.
Yeah, so the mutual fund, most people aren't buying in, $5 million lots, which is or 2 million or 1 million, which is the way ETFs work on the creation redemption. It might be $3,000, $5,000, $10,000. And when that happens, a portfolio manager may have cash on hand to meet that, or may have to sell to cover some of that. However, the nice thing with a mutual fund is this rule that Senator Wyden's going after applies to all registered investment companies, which is ETFs and mutual funds. So if there's a redemption large enough in a mutual fund of $5 or $10 million, the firm can choose to redeem those securities in kind and save the rest of the shareholders the tax burden that would be caused by someone selling that large amount. And that has happened in the past. Most mutual fund companies use that leverage or use that process when it's such a large redemption. But mutual funds have much smaller transactions, and because of that, you can't use that in-kind process on a regular basis. And you have to think of it this way, Bob. 80% of transactions that occur in ETF occur on the exchange. They do not cause a creation or redemption. It's usually just that other 20%. And that 20% can impact the shareholders of that fund dramatically if a rule like this was passed and everyone's taxed on every redemption.
Yeah. I want to move on and to another subject that's of great interest to the listeners, and that's inflation and how to deal with it. And Ed, I'm going to turn to you again. I know you get a lot of questions on this topic at American Century. The two questions I get all the time now, the two biggest questions, it's not about stocks. It's one, how do you protect against inflation? And second, how do you get a higher yield with as little risk as possible? Tell me what you're telling clients about. Let's just take the first topic, protecting against inflation. There's ETFs out there. Vanguard's got an inflation-protected securities, for example. How do you answer that particular question for clients?
So there's a couple of ways, and I'll keep it short. But you can always go with shorter-term inflation-protected securities, as an example. When you do that, you eliminate the potential credit risk that longer-term inflation-protected securities have. They tend to focus more on yield than inflation. The other thing you can do is increase your yield in your portfolio. And I'll give you just a short example. On the growth side of the equation, right, instead of owning pure growth securities, you could look at it another way and own convertible securities. And when you own convertible securities, you get a little bit of a higher yield. Granted, it's not that high. And in addition, you also tend to get a little less volatility as rates start to rise or as inflation comes into play. It's the same impact with when you look at fixed income, right? You want to go into, if you're going to worry about inflation and you're in fixed income securities, rates are going to start to go up as an impact of that, and the markets are going to get volatile on the equity side. So you want to shorten the duration. And as you shorten the duration, that's one way you can do it, because as rates rise, you'll get hurt less. The second aspect is, the other thing we talk about is being active, looking for a portfolio where an active manager owns it and can run it. And that way, if an active manager is running it, he or she can turn the portfolio over faster to take advantage of things that come up in an inflation environment. Where bonds may have fallen in value, they can add it to the portfolio faster and create a higher yield within that portfolio over time.
That's a very good example of where I could see active management would have a real advantage over passive management. Tom, I want to move on to the second question. This is the other big question, getting a higher yield with as low risk as possible. Now, I know some people are interested in preferred securities. I get a lot of questions about this. Some of these preferred ETFs are getting 4%, even 5%, I've seen. or higher yield. Are preferred securities, preferred ETFs attractive now? And what, if any, are the risks to owning those higher yielding?
Yeah, Bob, I mean, after 30 years of declining rates, advisors, investors are having to act harder. They're having to work harder. Active, as Ed said, is where a lot of the money's going. Advisors are doing a couple of things. Either they're going to cash or they're looking for alternative strategies for income, and preferred's a great way. I mean, in the financial markets, there's a great advantage in rising interest rates because banks tend to do better because they lend out money at higher rates, so it's more profitable. So you're going to see more there. American Century's got an active strategy in QPFF. We know iShares has PFF, and then First Trust, also one of the big ones, FPE. They've done some great jobs there, but I would tell you what Ed is saying about active is really going to be key and critical. And since they're offering these types of strategies just recently, and they tend to be smaller, you're getting some of their best ideas. We've had a lot of conversations with the folks at American Century, and advisors are coming in as opposed to going with the major market indexes because not all constituents in these fixed income indexes are created equal.
Yeah. And what I just want to remind everybody, it's good, Tom, to remind everybody exactly what goes on in preferred. Number one, generally higher yield than common. Number two, no voting rights. Important feature there, and that's a very important feature. And number three, they have a preference in the queue over common shares in terms of if the company goes bankrupt, preferred shares will get paid out before the common shares are ahead of the queue. And those are some of the obvious advantages right now, Tom. Now, Ed, then there are those, I don't know what you call them. I think core plus ETFs is what you said in the past. I think that's probably the right way to describe them. They add a bit of a high yield to a simple core bond fund like AGG, the big bond fund. They add bank loans. They add mortgages. I know American Century just started a multi-sector income ETF. MUSE is the symbol for that. Tell us about it.
Yeah, so Tom, it's designed to move with the markets in a sense. So it's searching for a higher yield. So you're going to invest in investment grade, high yield, as well as bank loans, potentially, even emerging market debt, where the portfolio manager sees they can add value to the portfolio, keep the duration. In this case, we try to keep it a little bit shorter right now because obviously we've been in this lower for longer environment, potentially going up. In addition, it offers a bit of a higher yield because of this. And so people have gravitated towards that because of the higher yield. It's grown a little bit, so the dividend has been muted to a degree. It's been around 3%, but usually it's a little bit closer and a little bit higher than that. But in this type of environment, gravitating towards yield has been what clients are looking for. And the way this product can move around, or any of the core plus products, truthfully, is because a lot of them are active, they can shift and move to where there's more yield, and they can also be a little bit shorter in duration. And by doing that, it covers sort of both topics in the search for yield, and also if you're worried about inflation, you're keeping that shorter duration, and you're taking advantage of both. Plus, it's what we mentioned earlier on the active side. We have somebody who's very highly invested in this, watching it from the portfolio manager every day, and they're actively looking for advantages in that. And I think in that space overall, Bob, it really can be advantageous to have it in the portfolio, especially as we've been in, as Tom said, rates have been falling forever, basically, it feels like.
Yeah, and yet, Tom, we know there's risks here, right? I mean, remember, we had money market funds that tried to add a little juice in 2006 and 7.
No, you're right.
They threw in some short-term corporates. So, it's nice to say, oh, yeah, I want a little more yield over here. But you are taking risk, right?
You're absolutely taking risk. And we're seeing more and more advisors, Bob, we survey them all the time, that are moving away from 60-40 because they don't feel like they're going to get that true return in the 40, and they're moving to 70-30 and even 80-20. And when you do that and you actually have more exposure on the equity side, even though you're chasing yield, but boy, we haven't had a major correction in a long period of time, aside from the blip that we had last March. These are one of those things to consider. I think other strategies that we're seeing in ETFs, these covered call strategies that are providing some great yield, ETFs like GEPI, GEPI, and NUSE, NUSI, and QYLD, a 7+% yield where you're also getting a equity exposure. This is something that can replace current equities exposure and also give you that yield you're looking for as well. So the ETF industry continues to expand and provide more options as people are chasing yield these days.
And Ed, remember, I'd be remiss if I didn't mention the big kahuna in this space, the actively managed bond fund, Jeff Gundlach's fund, TOTL. He's doing very well. I think he's pulling north of 2% yields right now, right?
Yeah, he is. And that's, again, that goes back to that core plus view or anything. You know, if you alter just the basic ag, right, which has a lot of treasury exposure, which isn't paying much, and you can shift that around without adding much risk to the portfolio, or really, if you're taking risk, getting rewarded for it with a higher yield, it really makes sense in the fixed income space. Because if, you know, thinking on what Tom said, advisors shifting away from the 60-40 to go 80-20, or even abandoning fixed income altogether, which some have told me, creates significantly more risk in a market that hasn't seen a significant pullback that's extended. We had one last March, but it didn't extend for a long period of time. And is it better to get some yield out of fixed income if you can search for that yield, whether it's the product you mentioned or some of the others we've talked about, either preferreds or even some of the covered call, and really get some fixed income exposure back in there that can really offer a benefit to a portfolio, especially if we pull back.
Yeah, this is really where the active management, I think, really pays for itself at this point. I got to leave it there, guys. Thanks very much. And that does it for this week's ETF Edge. My thanks to Eric and Ed and Tom. And we've asked Tom to stick around and chat for a few minutes to update us on ETF developments for the ETF Edge podcast coming up. Don't forget, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.